for a second that these two fine-looking gentlemen who really, hide their age well aren't just the smartest people in the space, because these guys are awesome, and we're really going to dig into it. So why does it not make sense to buy term and invest the difference?
So the way that I think about just any decision is, what outcome or result am I trying to accomplish? Term is a temporary contract. So what is life insurance? Life insurance is a contract between you and an insurance company. Okay, so there's different type of life insurance contracts. Term is a cheaper contract, but it's temporary. And so if we have temporary goals, then term might be a good way to go. So if we care about maybe insuring our income for 10 years, term might be the way that we want to go. But everyone in this room is thinking more than 10 years. And so if life insurance could be an asset for us, not just while we're alive, but after we pass away, why wouldn't we want that? And so the way that I just think of, and I love what you even said about Dave Ramsey, is Dave Ramsey is talking to a certain type of person that is literally spending more than they make, essentially. And so for those people, they shouldn't be in this room. They literally should cut up their credit cards, which is crazy for me to even think about, but they have like bigger issues to figure out. And so that's the problem, is a lot of people look at Dave Ramsey and they're like, oh, he said this about whole life insurance or about this in investing. And it's like, well, he's speaking to the person that literally is in debt. They have no money. And so they got to focus on some things before that. And so that would be the whole conversation about term versus whole life, is what is the actual outcome? And then let's get the thing in place that can be most efficient with that outcome. And when life insurance is set up and used properly, I think Brock and I would both agree that it's an amazing asset to help you with those goals.
I would also add the fact of we're going to talk about this, we're going to deep dive into whole life, but this is not us saying you should not buy any term insurance, but you absolutely should buy at least guaranteed convertible term insurance, so you are insuring your own insurability into the future. And maybe right now might not be the best time for you to buy whole life, but it could be in the future, so you make sure you can get that through the guaranteed convertible.
So we've established maybe why do it, why it makes sense to do it. Now let's talk about how do we know if it's a good policy? How do we make it a good policy? This is probably strength of company, maybe different riders. How do we make it a good product? What do we look for?
Yeah, that's a good question. So one of the first things that you want to ask is that person who is selling you that policy, that's going to set it up for you, ask to see their policy, see what they're doing, ask if they'll show it to you and what they've used their policy for. But once you have taken care of that and you're able to move forward on, hey, this is the right person I feel like that should be working with me, you want to make sure that they are using a dividend-paying whole life policy with a mutual insurance company. But in the way that we talk about building the policies is you want to make sure that it has paid-up additions riders on it. Mm-hmm. A lot of them are going to have a term rider on it to allow you to put that money in there so that it's not a policy that becomes a taxable policy in most instances. Mm-hmm. And you want to have a good, strong base premium, because that is what creates the efficiency within your policy. Those are probably the main things that you want to look for at first when we are setting up the policy.
Yeah, I'll just repeat what he says. If you write down in your notes contract and then company, under the company you want mutual, you want good ratings, and you want good track record. If you look at contract, you want it optimally designed, which is going to be, there's a base, there's a PUA rider, and in some cases we put a term rider. And it's a blend of how you design that to make sure that your cash is optimized and you have flexibility. So those would be like the two categories. We could spend we could spend a whole couple days talking about the pros and cons of how we design all those, but those are ultimately the two categories when you're looking at that. And you just want to make sure, again, that this is optimized for what your goals are. And a lot of the times we're on this stage because a lot of people think of insurance as this is what I'm going to do when I die. I'm doing this to check the box. We actually use life insurance as a place to save, protect, and use your money. So it's not really an investment. It's think of it as the middle place between creating money and then investing money. It's the middle account. And so if that's the case, flexibility, high liquidity, good long-term growth, tax advantages, all those things are important, and you want to make sure that the policy is optimized for that. And so, yeah.
we talked about companies. We talked about what you build into them. Something that I always look for, and I'm curious if you guys look for this too, I always want to know that my ability to borrow was really high. So if I put money in, I would like to know that I'm getting 80 to 90%, even up to 95%, like right away, day one, that I have access to that money. You can't ever get 100%. There's a cost to the policy, right? There's a cost to the company, cost to the person writing, fees involved. But over time, you'll notice that since the money grows and compounds tax-free, there's a certain point in time where that cost is erased and all the returns far exceed that cost for the policy. But is that something when you create policies that you want to build in a certain amount for people to be able to borrow against?
Yeah, absolutely. So when we build these policies, what you'll typically notice is as soon as cash value is there, and hopefully you can see it within that first year, you can borrow up to 95% of that cash value that you have available. And, typically the way that we've built our policies, it's usually probably between years 3 and 4, depending on your age and health, that whenever you pay $1 in premium, that cash value is also going to grow in $1 of value. And so you want to be able to see that your policy is growing in that way so that you can borrow against it and use it for other things.
Yeah, what I'll just say is we've said this early on, but it's like really, really important that everyone in this room gets this, is like, okay, why insurance again? You're not only that bucket, I would say 5 to 10, 15% fixed income is like great, but we also have the ability to use that capital to do other things. And so as an asset class, it's possible to put money into a life insurance policy and then borrow against that money and be able to put it into other assets. And so it's because of that ability that contract does. So not only what Brock said is accurate, it's like we're now getting access to the best deals because it's not just me with my net worth. I'm literally like insurance companies with billions and billions of dollars are getting in on these really, really safe, great deals. So that box is checked. But then I also have the ability to utilize my capital throughout my life. And that is why Justin in his book, The Lifestyle Investor, talks about using life insurance to acquire deals, and how Brock and I have clients all the time that are putting a lot more than 10, 15% of their money into life insurance, but they're not just parking it there. They're utilizing it as a place where they're giving their dollar multiple utility. And so that is one of the things that I think is really, really important for this room, because you guys have access to amazing investments. And so part of you were like, the opportunity cost of putting my money here and keeping it. Yeah, I understand that I want to do that from a safety perspective, but ultimately having the flexibility to have control over that money is pretty priceless in many cases.
So think about it this way. So a couple of things that I want to say. What makes you more money in the long term? One investment with one return, or two investments with the same money with two returns? It's not a trick question. It's being able to leverage something to have more than one investment. So let's say that the argument that some people make of like, well, it produces a fixed income type of return and I could get a better return somewhere else. I hear that, but the goal is not to maximize every dollar. The goal is to have dollars in all these different categories so that in any season you can weather the storm and actually have a good return. And that if you are getting this guaranteed return over here, because remember, life insurance is guaranteed. You have a guaranteed return, and then you have the dividend. You're going to get whatever higher of the two. So you have a base of a guarantee. You have the dividend based on how the company performs. Okay? So that's a given. If you can borrow against that and put it into another deal, another opportunity, well, now you have two returns with the same dollars. So let me know how you see that couldn't produce more wealth in the long term, right? That's powerful.
The way that doesn't work is if the thing that you invest in underperforms. Then that's, but if the thing that you invest in gives you a positive rate of return above the cost of borrowing or control, you literally get $1. You have a contract that gives you protection, all the benefits of insurance that we started with, and gives you the ability to say yes to that other asset. The other thing is, who in this room does not have a smartphone? So here's the deal. Does this smartphone, what kind of rate of return does this give you? None of us have an IRR calculation on what our smartphone gives us. Yet, we all would agree there's a lot of negative things with the smartphone, but we'd all agree that this is one of the most essential things to our life because of all the jobs that it does for us. My sound machine, my alarm clock, we call, text, I can email. There's so many jobs that I can literally run a business on the road with this. And yet this is not really an investment, but it's essential. That's the same way that I think of life insurance. I really see it as the essential foundation, but I don't necessarily compare it to an investment because of all the jobs that it gives me. And so that's my perspective. I don't know if you have a different one.
No, that's the same perspective I would have. And I think that's at the core of what we're trying to get at here is if you can understand that all investments that you make outside of your employer 401k, if you do that, has to start at a bank account. And so as you create money, you deposit it into a bank and you save that money over and over again. And then finally, you come across an asset and you have to withdraw from that bank all the money to purchase that asset. Mm-hmm. So the question is, does the bank continue to pay me interest on that money as I pull it out of the account? No.
You had heard them mention paid up additions. So to simplify what a paid up addition is, it's the cheapest form of extra insurance that you can buy. So you are growing the insurance for the smallest dollar, right? So it is much cheaper to buy paid up addition than the original policy. So you want to buy as much paid up addition as you can to allow you to grow that bank or that cash to as big of an amount as you can, but it costs you the least amount. So I just want to make sure we tie that in as we're discussing all of this.
That's great.
That was really good.
Well, let's do cons right now.
Okay.
I've got a few other things, but let's do cons now.
Okay. So just like you shouldn't trust everyone on the internet about people that are saying life insurance is a scam, you're also going to look on the...
You shouldn't trust everyone on the internet?
Yes, biggest takeaway. There are people that are also on the internet that make this life insurance strategy sound way too good to be true. It's like you get to put your money in life insurance and you go on vacations and you can buy groceries and buy cars, and by buying all these liabilities, essentially, you're going to become wealthy. And they're using half truths. They're using what you're earning in the policy, but they're not necessarily calculating the negative activity over here. And over time, they're creating a half truth, which is straight up lying. And so it's interesting because on one hand, I find myself on the internet trying to defend properly structured life insurance, but on another hand, I despise 95% of our industry. And so it's like I actually would agree a lot more with Dave Ramsey than you might think, because if you're not in a room like this and you go and you ask me like, hey, should I buy in life insurance from my life insurance person? Probably would say no, which might sound hypocritical, but both Brock and I have seen horror story after horror story after horror story, and a lot of times it's tied into a sales pitch that's not talking about paid up additions or policy design, but it's also, they get you on the hype fest of like, you can buy this car or go on this vacation. And at the end of the day, they're essentially money laundering using life insurance and getting paid a commission to run that money through. And so that would be just the thing that I would caution is and everything that we're saying is legit, but it's not like this magical, too good to be true thing. It's like, it's just let's save more. Let's have that place in a place that protects you, grows conservatively. We're talking a 3 to 5% tax-free long-term growth rate. So if you factor in taxes, fees, we're talking 8, 9, 10%. Everyone in this room has way better investments that can earn more than 8, 9, 10% when you factor in all those factors. So we're not trying to compare this to an investment, but from a place to store money long-term, it crushes any other accounts, even treasuries, even high-yield savings accounts. And so that's the perspective that both Brock and I have. But savings accounts don't necessarily magically make you wealthy. It depends on what you do with that activity, what you do with that money. Same thing with life insurance. Anything I know you see a lot of crazy stuff.
I would 100% agree. Like, you're not going to get wealthy buying life insurance and buying cars all the time with it. So just take that with a grain of salt. But I would also don't go into this expecting I'm going to have 100% availability to my cash day one. You are buying a product. So in those first couple of years, you will have the cost of the insurance. You're not going to have every dollar that you put into it. And depending on your age and health, you might have less than the other person next to you that might be buying a policy. So just be aware of that and don't think hey, this is the shiniest object in the world.
Yep. There's 3 cons to the strategy. If you want to write this down, this would be helpful. So con number 1 is you don't have all the money that you put in immediately. So it takes a few years to get to that point. So if you care about all your money liquid immediately, don't do this strategy. Con number 2 is not everyone will qualify health-wise. I think everyone in this room probably will. But there are people that are very unhealthy, or if you're like 95 years old, probably can't get insurance on your own life. Now the cool thing is you can get it on your spouse, your kids, your business partners. You can get creative and still get all the benefits as the owner of the life insurance policy. So the con is not that crazy, but it still could be a potential con. And then the third con of the strategy is you do not get a tax deduction going in. Now that's not really a con, because when life insurance is set up and used properly, your money grows tax deferred. You can use it tax free because loans aren't income, and it gets passed on income tax free. So if you get all those tax benefits on the back end, you're not going to get a deduction on the front end. Those are really the 3 cons when we boil it all down, if you structure the policy properly. If you don't structure the policy properly, we probably could add a lot more, but those are the 3 that I would say as it relates to that.
Those are good.
And I got to oppose you guys on something, because there is someone in the Lifestyle Investor Mastermind, actually a couple of someones, that do buy cars and they do make money, believe it or not. One of them, Joey Klein, just bought a $350,000 Porsche that
he drove it off the lot and it became $450,000.
Yeah.
An immediate $100,000 increase.
Because of how rare that car is. So
it's amazing.
Supply, demand. We got a few people. We got another guy in there that bought 4 of the same car that wasn't allowed in the U.S. until the start of this year. Actually, I think he bought 2 more, so it may have been 6, but at least 4. He bought at least 4 of these, and just the investment in those 4 cars he made over, he made somewhere between $600,000 and $1 million this year, just on that. So, so I guess some people can make money.
Not investment advice. Not investment advice.
So what I do, you're welcome. You now have permission to, no, I'm just kidding. But, and if your car is 6,000 pounds, you can get some tax write-offs. Okay. But beyond that, one thing I want to point out is most people feel safe having their money at a banks. Like, for some reason, that is like safe and secure. And what I want to share with you is that the solvency ratio for the banks in the US is anemic. It's atrocious. It's actually really scary if you knew what was going on. We've seen however many banks fail, but we don't see the life insurance companies fail. We don't see the big life insurance companies fail. Banks, to me, are like the gated community for holding money. Is a gated community really safer, or is that an illusion of safety? I would venture to guess it's an illusion of safety.
That's good.
And that, to me, is what banks are compared to life insurance policies or life insurance companies.
Yeah.
Hey guys, I just wanted to interrupt this incredible conversation real quick to tell you about something very, very exciting. We are having our 4th annual Whole Life Insurance Summit in June in Nashville, Tennessee. It's going to be the biggest venue yet. We're going to have the best speakers yet. We're going to have the most amount of people in the room, and I want you to come. You might be an advisor, you might be an insurance agent, you might be a financial professional. You need to be here. There's going to be incredible people, but we're also opening it up for the people that are not insurance agents, not financial professionals, people that are watching this show, are interested in whole life insurance, are interested in different financial strategies, and would benefit from meeting people, hearing different strategies, and being in a room of people that are thinking different when it comes to their money. So if you are interested or want to be at this event, make sure to check out the link below. It'll be thewholelifesummit.com. We cannot wait to see you. And there's more details on that page. Back to the conversation.
So next thing I want to get into, we talked about that there are different types. We've got a term, okay, which is temporary. And then there's permanent. But there's other life insurance that tries to compete with whole life, and maybe under a false pretense of, hey, let's run these numbers right now, even though we know it's never going to actually result the way that we can pro forma out. We can make an illustration based on something, and it makes it look like, these variable policies are much better than a whole life policy. I think it'd be great to get into that.
Yeah, so these are term insurance in disguise policies. And What the premise is they want you to think that you can get market returns, but it looks like whole life insurance. And so what's happening is the underlying insurance within these policies is a annual renewable term insurance. So each year your term insurance cost grows each and every year. They're going to tell you on an IUL, what's called Index Universal Life. So what they're doing is they're going to tell you, hey, you can have a floor of 0%. So if the market does -10 one year, well, that's okay. You'll just have a floor of 0%. So then they're going to have a cap. So what that would be is, let's say they had a 12% cap on the rate of return, then it would be, hey, if the market did 15, sorry, we're only just going to give you 12. The caveat is they control those terms. So what I would just say is look, if you're going to invest in the market, just invest in the market.
Yeah.
Right? Put your money in the market, invest that way, and then have money that's safe, that's uncorrelated with the market so that if it does crash, then you can get back in using, something that's uncorrelated. But there's no reason to try to mix the two because you think you are getting a deal because it costs less, so they say.
Yeah,
Those commissions are pretty nice.
Yeah, very nice.
Very hefty commission.
They come with nice trips.
It's interesting how incentivized people are to market those policies.
Yeah, show me an incentive and I'll show you an outcome.
Yeah.
So this is what I would say as it relates to Index Universal Life is I 100% agree with what you're saying. It's it's a term chassis, and then what they're essentially doing is they're taking the fixed return that they're getting with their portfolio, and instead of just giving you the 3, 4, 5% internal rate of return long term, they're putting it into an option contract. And then that's how they can give you upside and no downside risk. But the reality is if you get at the downside, you still have cost of insurance. So it's misleading a little bit. And then the other thing is there's a lot of levers that they can pull. So they could say, hey, we had a tough year, more people died, we're gonna crank up the cost of insurance a little bit more. So the philosophy is if you want to invest, if you're looking at life insurance as an investment, which is a faulty paradigm in my opinion, you can see where people fall into this. Oh, I get a life insurance tax-free wrapper and I get a higher upside than whole life because any IUL structured the way that they want to structure will look better on paper than whole life. So you could be like, Caleb and Brock, why wouldn't you sell me this thing that's going to tell me that I'm going to earn $1 million in the next 40, 50 years more than this whole life? And it's trust me, we would make more if we sold that to you too. And it's the easiest pitch in the world. The reality is it's not going to happen. And then the other reality is, why would you want to invest in insurance? If you're not going to invest in insurance, if it's just going to be a place to store, use, and protect your money, why would you want to put that in a place that had more variables? And so the whole philosophy is why are we putting our safe money and speculating with it? And when you understand that, it's why would I want to build my house on a faulty foundation? And even the people that are very pro IUL will admit it's a lot more quote unquote risky, but then they justify it. And so I'll just say if you want to invest your money and you want to look at an IUL versus the market, you can have a debate. I would choose just putting it into an ETF, but that's where I agree with Dave Ramsey. Don't invest in life insurance because I think you can get better investments, especially if you're in this room.
Something else that I add to that is you will often hear, I've spoken to a lot of people and they think, oh, well, I'm being sold whole life insurance. And then when we take a look at what they actually have Index Universal Life Insurance. We asked the question at the beginning, what is it that we need to look out for? That's one of those things is make sure that it is actually a whole life insurance policy that you're being sold and not an Index Universal Life Insurance because they are different.
Financial services as an industry, I believe, is corrupt. I believe it is misaligned. I could go on and on and on, but that is one to me where it's in life insurance, I actually want to invest in the things that give me the most benefit, that are the lowest cost. I just want to also toss out there is a time and place for premium financed life insurance. It should, and that's where you can get fake lending to pay the premiums. And then the other category that at a certain point when you get there, private placement life insurance makes a ton of sense. It is, in my opinion, and many that I know, the single greatest wealth building tool that exists. That's something that is very relevant inside of the lifestyle investor community. And I just wanted to mention that so it's on your radar. But everyone that I know that has done PPLI has first done whole life.
I kind of want to run just a quick scenario, easy numbers, right? So say it's $800 a month or it equals out to $10K put that in after 4 years, it's 40K. What you're saying is that you're getting interest on that money that's in this account, but then you borrow, let's say 40K plus. How does that work?
Maybe you're borrowing 35K, right?
Actually, that's too hard. Let's do $100,000 in the cash value. $100,000 in the cash value, right? Yeah. You've got $100,000 in cash value, right? You can borrow 95% against the policy. So you can get $95,000. And so when you ask for that loan, right, it's not credit checked. It doesn't affect your debt to income ratio. There's no qualification for it. They'll wire it to you. On top of that, right, so when you ask for the loan, the insurance company determines the interest rate. You determine how, when, and ultimately if you pay it back, you want to pay it back, right?
Meaning you're not forced to pay back on any schedule. It builds flexibility. So you can, if you have a year and you can't pay anything back, then you don't have to.
Yes.
Right. So these loans are charged in arrears on a 1-year time frame. So if you were to have that number out, and here I go, hard math again. So you would have hold it like a rapper. So you would then have 6% on that money. Let's say that the loan was 6%. You would have 6% that the insurance company charges you at the end of that 12 months, right? Now, if you paid it back in 6 months, you wouldn't pay the full 6%, right? Because they would take that interest rate divided by 365 days, and however many days that you had it outstanding when you paid that full note back, that's the interest that you would pay.
And technically, you don't even have to pay the interest back. You could choose, it's best to, but in a bind, you don't even have to do that, and it will roll to the next year.
I mean, yes, we on stage should say you should pay your interest back. You should pay your interest back. If they're charging you 6% and you're earning 12%, why would you want to sell at 12 to pay a 6?
Yeah.
So it's like, we have to, again, you can get yourself in trouble if like you're not earning 12, you're going on vacation or buying a car that doesn't appreciate. Like that's where you can get yourself in trouble. But at the end of the day, there's some of our clients choose not to pay the loan back, which is kind of messes with our mind. But insurance companies are the only the only companies out there that don't require you to have to pay a loan back, because they have collateral, which is your death. They ultimately are on the hook. They have a liability on your death. They have to pay a ton of money out. So they're like, if you don't pay your loan back and you die, because you will die, they will pay your death benefit minus what you owe the insurance company. And since they've been around for 100 plus years, they're playing the long game. So their whole deal, like that is also like no other company can do this, because they're hedging both interest rate risk and mortality, the fact that we're going to die risk. Most companies only have one, so they require you to have to pay that money back because they're hedging their risk.
And there is a middle ground where you can pay the 6% back.
Yeah.
With the 6%, you're making 12%, so you take 6 of it to pay it back, and you're still netting 6.
Total flexibility.
You explained that what direct or non-direct recognition, like what happened?
You got this one.
You got your loan.
Yeah, so their direct recognition versus non-direct recognition is how the companies recognize you taking a loan. So a direct recognition company, if in this example, if you have $100,000 and you take out $100,000 as a loan, they will directly recognize that and either give you a higher dividend payout or a lower dividend payout on that $100,000 difference. And that's they essentially, that's like one of the things, if we take a step back, when we talk about mutual companies, the mutual companies, the policy holders are the owners of the company. So ultimately they are incentivized to help you. And so when they directly recognize that loan, they're essentially have some type of calculation that may affect your dividend slightly down lower or affect it slightly above based on what the interest rate environment has been like. A non-direct recognition company won't directly recognize that loan. So it's like whether you take a loan or not, they pay you exactly the same dividend as people that do take a ton of loans. The answer, I think Brock and I would both agree, long term doesn't matter. If you're working with a mutual insurance company it does not really matter. In the short term though, if you're taking a lot of loans, so like if you're like, I want to use this, I want to front load. A front load is essentially where you put a ton of money in year one. Don't have to put that in every year after, but you're going to use a high percentage of that. There's an argument to be made that a non-direct recognition company might be more favorable. But over time, you want to work with a company that it's just, if you actually look at the real math, direct versus non-direct is not that big of a deal when you zoom out if you're with the right company and the policy is properly designed.
Even if you're like, take one, like as you take yourself, that reads very highly on the cash value that
Yeah, I would say if you're going to leverage a lot, which I don't think Brock and I would both recommend, like constantly leveraging all the time. If that's the case, a non-direct recognition company eliminates a lever that a direct recognition company could give you. Now, there has been, like in the past when interest rates were really low, they would actually give you a higher rate on loaned money. So it's one of those things where both the mutual companies are trying to be as fair as possible. And so usually direct recognition companies are paying maybe a higher dividend than non-direct recognition companies. So again, when you zoom out, it matters way more about the design of the policy and is the company solid. And then, yeah, if you're going to heavily loan, probably a non-direct recognition company eliminates maybe a factor that you never have to worry about.
And just to add another wrinkle to it, in a low interest rate environment, it is also even more of a moot point in the sense that you can have these specialty lenders that you can borrow from that will use your death benefit as collateral. And then you can get a lower rate of interest than what the insurance company is offering. And you might even be able to get an interest only. So if that's the case, then again, it's not as big of a deal. But it is in a higher interest rate environment, in my opinion.
And the only
And high borrowing.
the only caveat to that is sometimes some of these third-party lenders need you to have so much in cash value before you can do that.
You've mentioned being able to insure our children as well.
Yes.
At what age can we insure them? How do they determine the insurability or the value that they can place on that without having an income?
Yeah, that's a great question. So number one is they can have 75% of the death benefit of whatever the owner has. So if the owner of the policy has $1 million, the children, depending on the premium, can have up to $750,000 of death benefit. Now, when you
Cheapest policy to write, period. The
Absolutely.
earlier, the
Absolutely.
Right.
And if you have multiple kids, all the policies need to be uniform in some manner, whether that's death benefit or premium amount per child.
Anyone that you have that you have an insurability on, anyone that is family, is coworker, like anyone. Yeah.
14 days old.
14. So
It used to be 6 months, and they have shrunk that.
this girl has life insurance on her already.
Oh yeah.
what type of situations do you recommend is from both the policy? What's
Yeah, great.
probably master profile?
Yeah, when you think of life insurance, think of two types of buckets. Cash flow, so every year you're putting in the same amount. So let's use $50,000, $50,000, $50,000. Well, maybe you're sitting on $300,000, but you don't necessarily want to put $300,000 every single year. And so what you can do is you can figure out a way to take a portion of that, maybe 150 or 200, put it in year one, get 85 to 90+% liquidity immediately. And then the next year, you now can put 50,000, 50,000. And so like that's the reason why you would want to front load is it comes down to cash flow.
And the more you front load it, the faster the policy becomes self-funding as well.
Just open up a can of worms. But
I know. We can't even get to self-funding at this point. But think about a time and a space where maybe around 7 years, you actually don't even have to put in the premium because the policy makes enough to cover your premium payments. Now, that doesn't mean that you stop doing the premium because the more premium you put in, the more it grows tax-free. But there's an argument to be made in a tight situation that you wouldn't have to put premium in.
So can you speak to a writer to increase the amount of insurance at some future date? How does that work? When does it make sense? What's the cost to do that?
Yeah, so that is, each insurance company is a little bit different. It's called the guaranteed purchase option. And there's at certain ages, that you can purchase a certain amount of death benefit. I looked at one last week and it was like you can purchase up to $2 million of extra coverage at ages like 22, 25, up to age 44. So I think it's like $5 per extra thousand that you add. So it'll be a wee bit more expensive.
Yeah, and I'll only speak for us. It's not that common. What we usually do instead is get a convertible term policy to lock in cheap insurance and then give you the ability to convert that to a permanent policy and not have to prove insurability.
What's the maximum coverage amount? Obviously for different like income levels, but how does W2 income versus passive income? The way it is to be maximum covered.
Great question. So that,
Can of worms.
yes, it was. So that's called your economic life value. So each insurance company has a multiple factor per set of ages. So if you were 30 or somewhere, let's say 18 to 40, they would say that your multiple factor is 30. So you would take that 30 and multiply it by your gross income, and that would tell you the most amount of coverage that you could purchase today. That's what your gross income, what's coming in the door.
I would say guidelines are meant to be stretched. So a good cover letter, you just have to paint the picture of what insurance companies don't want you to do is be incentivized to kill yourself or have your spouse or someone that is going to get the money to incentivize to kill yourself. So you have to essentially assure them that you're worth more alive than dead, and that's essentially the equation.
It's good. Gotta get morbid.
Are there any creative ways to utilize this within a business?
No.
Actually, that
We'll do another session on that.
Yes, yeah, there's
The answer is yes.
key man insurance, buy-sell agreements, deferred comp. There are split dollar agreements. There are a ton of ways. Go look at John Harbaugh with Michigan in his contract. That's a good way to put it.
Is there a point where you all recommend buying whole life for your sibling, your spouse, versus buying additional whole life policy for yourself?
Great question. I think that, number one, it's personal on that. But I think that your main focus first should be on yourself because, you're the one producing the income. You're the one that's bringing in the money. So
If in fact you are the one bringing it home.
if in fact you are the one bringing in the money.
In some cases, your spouse could be the breadwinner, in which case you might insure that.
Absolutely. So focus on the one that's making the most amount of income first. And then once you get to a place where you're like, hey, we're putting our kids on payroll, that could be an incredible opportunity for you to start those policies on the kids.
we talked about how much should be insured for your gross income. What if you took a W-2 exit and you no longer have a gross income? Did that change your policy?
Guidelines can be bent. No. Once you get your life insurance, it's like you could be making $1 million, get your life insurance, lose it. It's like a mortgage, I guess.
It could impact what you could get if you don't have a policy written.
Yeah, for sure. Yeah, for sure. But once you get it, it's not like they're not asking for your P&L every year.
What if I'm putting in $10,000 a year in my life insurance policy, then I come into a bucket of money? Do I need to get another life insurance policy, or can I increase my claim every day?
The short answer is yes. You have to get another life insurance policy, or if you have convertible term insurance that converts.
Or if you have it maxed out.
Yeah, but if you're if you're already maximizing a policy, the answer is you have to start another policy. If you're not optimized policy, yes, you can put it in, but that's Brock and I wouldn't necessarily recommend like, oh, let's do a non-optimized policy so that if and when you exit, you would try to optimize today and then give you better options in the future.
Hence the reason Garrett has 27 of them.
Yeah.
But by the way, think about how young he started with this policy.
Yeah.
That's really cool.
How old were you, Garrett?
19.
And just when I was 21, so you have me beat by 2 years. Yeah, I got a life insurance policy, and I convinced the insurance company that I was worth $10 million, and I was not. It wasn't. I told them that I was going to be worth so I just painted a picture. I actually sent them a video. It was the first video that they've ever received in the company as a cover letter. But they were like, all right, so it's one of those like guidelines. It's like can't do that for everyone, but it's like you just have to paint a picture of why they're doing this. And a lot of times these companies will work with us, especially because they like Brock and I.
Correct. Brock. And I would say, I got my first policy when I was 18, first day on the job, haven't produced any income, that's when I started my first policy and then did another one later.
How much was yours? More than 50?
$561.78.
Inflation.
Still keeps coming out of my bank account.
Wow, I love that. So it's worth more than Garrett.
Yeah, so what are your thoughts on college tuition for kids? The idea of 529s versus taking an overfunded policy, and potentially the thought process around taking money out of the 529s to put it into whole life.
I don't know if we're allowed to tell you that you should pull your money out of your 529 plan to put it in a life insurance policy. But what I would say is, having that life insurance policy to help with college tuition for kids is one of the most powerful things you could do because, sorry, I'm about to do this. Think about when you went to college and then when I went to college, right? Probably vastly different. But you want to think about, is your kid going to go to college? What if they want to be an entrepreneur? What if they want to start something else?
My biggest issue is there's so many requirements and so many, it's like the covenants that you get when you borrow money from a bank. It's like, you can't do this, you have to do this. So it's like, well, what if your child wants to do specialized, something, a specialized skill? It may not be covered. What if your child's an artist? That may not, there's just a lot that isn't covered in a 5.9.
I was just curious about long-term care riders.
It's great.
Cost-benefit analysis and how.
Great question.
I just did a video on this with one of our team members that broke this down. And so, but it was like a 40-minute video going into the benefits, pros and cons. So the short answer that I'll give, and then I'll hand the mic to Brock, is yes, you can do it. In many cases, it's an amazing thing to do. That's one of the reasons, why can maybe life insurance companies give you a better deal than person off the street is because they're bundling that risk. And so there's a world where that could be a really, really powerful thing. Even if you don't get a long-term care actual rider, which could be great, I think every life insurance company that we work with have what's called chronic illness riders and accelerated illness riders. And it's essentially, it's like, if God forbid something happens to you and you are terminally ill or you can't perform certain activities of daily living, you have the option to be able to spend down your death benefit while you're alive. Not to say it's super, you just get that option. And so we can't legally say that that's long-term care insurance because it's not, but it's an option that you have that you wouldn't have if you didn't have permanent life insurance.
Yeah, I would say the same thing. Is almost all of the insurance policies nowadays, I believe, come with a chronic illness rider. It's not an extra one you have to add. It's just on the policy. And you can use that as tax-free up to a certain percentage of your death benefit. But also remember, you also have that cash value that you can borrow against if you needed to on a tax-free basis.
And there are riders also that you can put on. So you can get disabilities.
Waiver premium.
It's not necessarily tied, but maybe it's through the same company or maybe it's through another one. But you can also get the ones where if you are unable to do your job in the way that you're doing it, you get paid a certain amount per year in perpetuity.
Yep. So one of the most important riders that you should have on your policies is what's called disability waiver of premium rider. And it just says, hey, if you are disabled, you can no longer work anymore, then you will pay a little bit extra within the premium, but the insurance company will step in and pay those premiums for you for as long as that disability lasts or you pass away.
Well, this was a pretty interactive session. Can we recognize these two? Thank you so much.
Good job.
I told you they're brilliant. These guys are well ahead of their age in knowledge and experience, and they have written thousands of policies, which is cool that they've been able to do that this early in their career.